Carl, the bears are twitching, right? And we saw it yesterday, and now we're seeing the same trend because of what China's saying about treasuries.
Yeah, well, I think that the economic fundamentals in the U.S. are probably more important than what China is saying. I think that the key element for the bond market is that the Fed is hiking rates, and historically, 5 of the last 6 times they did that, the bond yield sold off on it, so that seems like a good bet. And we also have inflation expectations, even though they're not actual inflation yet, they're expectations, and that feeds into the yield. So normally in this phase of the Fed cycle, we would expect to see bond yields to go up. Everyone should know that. Everyone should be expecting that. That doesn't mean that there's not a market for bonds. There are people who still have to buy them. There are people who are going to buy them for longer term who will welcome the higher yields. For a trader like Bill Gross, the capital loss in 6 months or a year is important. But to an insurance company, the higher coupon is more important to them. So the bond market is not dead. It's just dealing in a bearish trend that a lot of people in the market haven't seen before. They have to learn how to do it.
But if it goes to 2.6, 2.7% today, the rapidity of that could actually take the markets quite a lot by surprise.
Well, I think that's probably right. That's in the hands of the technicians as to how we're going to get there. From our point of view, we don't see any abrupt change in the fundamentals. We see inflation moving up only very slowly. We see the Fed moving maybe a little bit more aggressively than the market does in the new year, maybe 4 hikes or instead of 3 or 2. But we don't really see a big explosion happening in the yield. So the technicians will take us up on a day-to-day basis. But the economics, I think, call for a slow, steady rise in yields.